Hello and welcome to the Nest Egg Builder Show. Today we have John Berlet. John is a financial services consultant and real estate sponsor focused on providing solutions for individual families, business owners, and accredited investors by employing various tools and skill sets accumulated during his years as a registered investment advisor, an income and asset protection specialist, investor, and developer. He assists clients to work and works harder for them. What he does, he's a seasoned investor who can help accredited investors locate great deals even in volatile markets. He educates accredited investors about the amazing benefits of opportunity zones and puts his 30 years of experience in real estate investment to work locating the best real estate deals on the market. What does he do as a safe money expert? He's one of a handful of certified federal retirement consultants with years of experience in rollover to protect growth and income. Welcome, John, and thank you for joining us today.
Thank you, Jonah. Glad to be with you all, Peggy. Happy to share a little bit. Actually, today's focus is for non-accredited investors, and so that part of my bio was prior. I had an Opportunity Zone Fund that was a Reg D 506C offering that was restricted to accredited investors. But today we're going to talk about a pretty exciting new offering I just launched 2 weeks ago under Regulation CF, which stands for crowdfunding. And it's really a way for the average person to participate in private equity, and we'll get into a little more about the details. I thought if it's okay with you all, I'd share a little bit about my background and how I got to where I am at this stage in life. So I spent a little over 40 years in Austin, and I had what's called a registered investment advisory firm. I focused on safe money, retirement income planning. I primarily used some instruments called fixed indexed annuities. I built my book of business up to a little over $52 million. Had a law firm offer me a chunk of change for that book of business in March of 2021. That resulted in a capital gain event for myself and caused me to begin a deep dive in this new tax incentive called Opportunity Zones. So that kind of brings you forward now. I help clients with cash balance pension plans, Roth conversions, income and tax planning was a big part of my practice. Now, I also have a passion for real estate, and many of my clients have some money earmarked for, a little higher risk in their portfolio, but by and large, I'm a safe money guy, and I know fixed indexed annuities extremely well, frontwards and backwards. Now, today, what we're going to talk about is my new fund called Core Tax Deeds. And for those of you who may not be aware, Texas is pretty unique, one of 5 states that actually sells what's called redeemable tax deeds. And I started buying these in Austin at the courthouse steps in 1993 using the self-directed IRA. So I'm considered a pioneer in the self-directed IRA space as well, and ended up parlaying a $26,000 IRA to a little over $300,000 in a few short years, buying property at tax sales for pennies on the dollar. Now, every state's a little bit different, and each county within the states are a little bit different. So I'd like to, if it's appropriate, stop me anytime, Jonah, if you have questions or want to, I think we're going to do Q&A at the end. But Texas is unique because when someone is delinquent on their property taxes, there's a lawsuit filed, and typically 2 years of delinquent before they bring it to suit. But the highest bidder at these auctions is actually awarded a sheriff's deed without warranty, subject to the prior owner's right of redemption. So you're the new owner day one if you're the high bidder, subject to the prior owner's right of redemption. And if the property is non-homesteaded, non-agriculture exempt, and non-mineral rights, then the short redemption period is the shortest in the country, 180 days. If they do redeem the property, they have to pay you or us what we paid plus a 25% penalty. And if there is a homesteaded property, which we totally stay away from, we'll inadvertently acquire some here and there, but for the most part, we're buying vacant lots, acreage, and commercial properties that have the short redemption period. The tax liens are the highest priority lien on the property, and the mortgage liens are inferior. So, all of y'all who have real estate experience, you know, typically the lenders require you to escrow the property taxes so that, they're not in an unfavorable position. Many of the properties, I've purchased 47 properties over my career in this world in tax deed properties, and only had 3 redeemed. So I have a pretty big successful track record in this space. And what's really got me excited here in the last 6 months or so is the trend now in Texas is, instead of having the live auctions the first Tuesday at 10 a.m. at the courthouse steps each month, about 30 or so of the 254 counties are now having these auctions online. So it allows us to be in a lot more counties at 10 a.m. on the first Tuesday of the month to be exposed to a lot more properties. We tend to stay away from the larger metro areas where there's a lot of competition, a lot of people bidding up the values much higher than we're willing to pay. I'm going to share my screen right now if you let me. Let me know if this pops up. Are y'all able to see the screen now?
Yep, we can see it.
Okay, so this is our investment portal. And again, this offering is under regulation crowdfunding. Took us a little over 6 months to get through all the legal hoops and all the compliance team. Now, we just launched 2 weeks ago, and we have raised already $83,000 with 6 investors. Minimum investment amount is $2,000. You'll see right over here. So a person can dip their toes, test the waters with a very minimal amount of investment. If they come in a little higher, we have some incentives, some bonus member units. If you come in at 15,000 level or at a 50,000 level, there's a 5% bonus. And then if you come in at 50%, it's a 10% bonus members. We are an LLC managed by a company, which I am the manager, sole manager, called Tax Deed Investors. And we're offering the equity interest to the Reg CF member passive investors with and offering a 12% preferred return and splitting the profits 60-40 until the investors are made whole, and then we go to a 50-50 split on the profits. Happy to get into those details a little bit later, but I'd kind of like to give you the big picture now. And again, all investment offerings must go through this portal called that you can reach at invest.coretaxdeeds.com to get our Form C, which is loaded with 80 pages of disclosures and risk, all disclosed why you wouldn't want to invest in this offering. This deck I'm going to go through, this is this material here on the left side of my screen. Audited financials are completed. There's a blank subscription agreement you can download. Investor forum. If anybody's not familiar with EDGAR, I was not familiar with this. Stands for electronic formatting to file this with the SEC exemption Reg CF. All these documents had to be prepared in this format, EDGAR filings. We are insured. We have insurance which covers negligence. I'll skip over this now and start going into the offering. So we're buying non-homestead properties, vacant land, acreage, and second homes, condos. I'll show you a little bit of my experience in this space in the last page, but it's 100% passive. We're looking for non-active member investors. And let me back up just a minute and tell you, the management team I put together is phenomenal. I have 4 investor partners that are on the management entity that have put in between $25,000 and $50,000. One of them is a 25-year friend of mine in Austin who's a 40-year real estate attorney. In fact, his name's Bruce Morrison. His father was a a law professor at the University of Texas for 30 years, from 1947 to 1977. So he grew up in the legal world, and now he's 70 plus. So I'm real happy to have him on my team. And these investor team members are helping me with the underwriting. They're going out to look at the properties. We won't bid on anything without first seeing them firsthand. Of course, we do a lot of underwriting. Two of the other field underwriters are a longtime friend. One is a 50-plus year friend, actually my ex-brother-in-law. Known him for 55 years, even though his marriage to my sister only lasted about a year. We've maintained friends. And then another one of the field underwriter managing investor partners is a gentleman named Ron Kettner, who's a pretty large ranch owner in Williamson County, just outside of Austin, where Samsung is building a huge plant and property values going nuts all around Austin. So we're the management team. We're doing all the heavy lifting. We're screening the properties, underwriting, doing our diligence. Our goal is to buy at 30 to 40 cents on the dollar, sell after the redemption period as soon as 6 months to 12 months for 70 cents. So we want to wholesale the properties. And we've come up now with an incentive, a suggestion from Peggy, matter of fact, to offer these properties once we've gone full cycle, 6 months to 2 years, if it is homesteaded or mineral rights or ag exempt, then we're going to offer these properties first to our passive investors at a discounted rate before we go to the open market. So I love that tip. We're just about to have all that in place now. Let me tell you the difference why Texas, 5 states are what's called redeemable deed states. Majority of states are lien states, where you buy a lien and you bid down the interest rate. And I actually bought a couple of them up in Colorado in 2021. I know a little bit about how they work, but not a whole lot. I really understand redeemable tax deeds. Texas, Georgia, Tennessee, I believe it's whatever that state is, Rhode Island and Hawaii operate a little bit different, but they're redeemable. In Florida, these are both lien states, the red states. So the difference again is when you're the high bidder at a redeemable deed state like Texas, you're the new owner that day. Day one, you have all the right title and interest as the former owner, subject to their right of redemption, which again, if it's non-homesteaded, is up to 6 months. So worst case scenario is the property is redeemed. They have to pay us what we paid plus a 25% penalty, which in effect is a 50% first year yield. Again, I've only had 3 properties redeemed out of 47, so less than 10%. My passion is in dirt, land, the houses that we will acquire. And by the way, we're going to buy our first properties a week from today, May 7th. Was the first Tuesday of May, and 10 a.m. we'll be bidding in 12 counties in Texas. There's 254 counties, and the larger counties are seeing a lot. Dallas, Houston, they're all online. We kind of tend to be out in the tertiary markets, the smaller communities, where we're not seeing near as much competition, so we can buy right. So here's a little definition between tax deeds and tax liens. What is a tax lien? I'll go over this real quick with y'all. According to Investopedia, it's an investment niche that's often overlooked by investors, is tax liens. Now, if you're buying tax liens, you're mostly an interest buyer. You're unlikely to get the land. 97% of tax lien states, the properties are redeemed. So you do get an interest anywhere from, depending on how low you bid the interest down, and all the way up to 18% in some states. I don't know very much at all about tax lien purchasing. In Texas, I know a lot. Tax deeds, as I mentioned, if you're allowed to maintain the property. If your property needs a roof, some plumbing repairs, if there's some necessary maintenance, and you choose to make that repair, then if the property is redeemed, you also get 25% penalty on any money you spend maintaining the property. Okay, that's important. we are, again, I'll go through the offering documents, offering a 12% preferred return, which is the first money to come out. The management entity is getting a total fees of 6%, 2% when we buy the property, 2% when we hold the property, and then 2% when we sell it. So a total of 6% in management fees will come out of the offering. The 12% pref, once we start selling some of the properties, we'll divide the profits up 60% to the limited partner, member passive investors, Class A members is technically what you refer to as, and then 40% will come to my management team entity. Okay. So change. We've all seen how we've had a huge run up in the stock market, huge run up in real estate, gold, precious metals now at all-time highs. Most likely we're in a bubble in many asset classes. Time with the Texas tax values typically lag the market a couple, 3 years, the tax assessor's office, but people are seeing huge increases in their taxes, property taxes. And the number of tax delinquent properties now at all-time high across the country. So it's a good time. And then again, with the movement in Texas, we're a little bit behind the curve on this online auction. But now we're embracing it. In fact, Travis County, Austin will be going online June, the first sale in June. And again, the online, they're primarily the bigger municipalities, Dallas, Houston, Harris County, I think, has 3 different taxing jurisdictions, all online auctions. But out of 254 counties, they all have these sales. By state statute, they have to be held on the first Tuesday of each month at 10 a.m. So we're able, again, to do our diligence, do our research. Again, this month for the May sale, we've researched 15 counties, looked at somewhere over 90 properties, and we're down to 7, 9, 12, about 21 that meet our criteria that we'll be bidding on. Again, the minimum's $2,000. We have clients using Roth money. I think it's ideal for Roth because of the potential upside being so great. Can you get out early? No, you need to plan on a 3-year term. It's not suitable for your fixed to house money. Take a trip. Any short-term money you may have would not be suitable. Again, we anticipate distribution to profits within the first 18 months. We'll put the properties on the market. We'll do the quiet titling work through title certificates prior to this redemption period, probably in month 4, month 5. These are a few of my actual properties I acquired in my past at tax sales. And I had 5 legal attorneys, 3 securities attorneys, 1 real estate, and another attorney, kind of a generalist. They advised us to remove my real home runs. I've had 3 properties that are much greater successes, but I'll tell you about them. I think it might be okay to discuss them, but it's not on my track record because we didn't want to oversell the idea. The upside. These first 1, 2, 4, 6 properties are all unimproved properties, raw land, vacant lots. This one here, these 2 were side by side. We bought them at tax sale. The first one sold first for $45,000. About less than a year later, we sold the second lot right next to it for $178,000. They were about 1 acre apiece. And this second one now has a fire station on it. So it's been improved, developed. This site here is on the golf course. This is a waterfront lot. I had a lot I bought that was on a very small corner, joined a Catholic church, and bought it for $1,100 some change, sold it for $38,000 to the Catholic church. So you just never know. It's real important when I do the diligence to be aware of, what's contiguous to the site. Anyway, so I've kind of gone through this pretty quick. I don't know how we're doing on time. You want me to share a little bit more at this time, Jonah, or want to open it up?
Let's open it up. I've got some questions, and I'm sure Peggy has questions, but let's open it up.
Wonderful.
Yep, if you can stop sharing.
Stop share, okay.
All right. So one of the things that I have a question on. So you're staying away from homesteaded property. Why is that?
Because of the redemption period, primarily. It's a 2-year redemption period. And we will inadvertently acquire some. We try to, we use in our underwriting, we see if there's an exemption of record at the tax appraisal office. And Texas is kind of strange. You can claim homestead even if it's not a home. So it's a very homestead favorable state. But the primary reason we want to stay away from it's really not a bad deal. Once we get fully funded, we'll probably buy more because they tend to have occupants. They tend to generate cash flow. I mean, you can create some pretty good cash flow. And if it gets redeemed in the second year, I failed to mention there's a 50% penalty. Does that answer your question? Why we want to stay away from not only mineral homestead properties, but mineral rights and ag exempt. They all have the 2-year redemption period.
And what's the redemption? So are you saying the other types have no redemption period?
6 months.
What's the redemption?
180
Okay.
days. If it's not homesteaded, raw land, commercial building, second home condominium, it's 180 days. If they redeem it in the first week or the 6th month, day 179, that must pay us all our cost of holding and buying that property plus a 25% penalty.
Okay, and then and you might have to walk us through an example, but we'll go through some of the questions first. Actually, let's do that. Let's go through some of the other questions because I'm not sure I understand what the 12% pref is. Is that just you're going to pay the limited part, the passive investors before you pay yourself?
That's exactly right. Yeah, that's the first money to go out.
Okay. And then it's 60-40 until, let's say I invest $10,000, right? So then you pay, and you say up to a 12% pref.
Yep, that's
which is
legal definition. That's not guaranteed. It's not certain. And the reason the lawyers say that we have put up to, because if we bought everything that was environmental problem, worst case scenario, we had no profits, then you wouldn't even get 2% pref.
All right. Okay. All right. So let's go through Peggy's questions, see if some other people have questions. And if we have time, I would like if you picked your worst case scenario and ran through how it gets distributed. Peggy, do you have some questions?
Oh, of course I do. One of the questions is about the liens on the property. So when you buy this tax deed, the mortgages go away. What is the position if there's an IRS lien or a state tax lien? Not property, but state tax. Do they?
Estate or state?
State, like your state. Oh, but you're Texas. Texas doesn't have state taxes, so forget that one.
Let me
What
address
about
that. Great question. All liens are extinguished except, believe it or not, weed liens. I call them weed liens. Weed, like when the city mows the grass because it's overgrown. Any municipality lien, if there's been a demolition lien,
Fire.
yeah, anything like that. And we check with the city, but to find out, in many cases they are, and overgrown grass on these vacant lots, infill lots. So those do not get extinguished. Mortgages are extinguished. The IRS is not extinguished. They have 120 days to make a claim. Rarely do they make any claim, and rarely does it come into play, but we need to be aware of IRS liens if they have a 120-day right of redemption period.
Thank you. I have a couple more questions, and one of them was, you said when you're online, you still send somebody out. So when you're online, so this will be two questions together.
Okay.
They must have a list so that you can send somebody out. Is there like a day for open house, or do your people just walk on the property or drive by, or, what is, and is that legal? And
Great
I
question.
want to
Really good.
understand
Really,
these people. Do they
Yeah.
even know they're going to sale?
Yeah, really good question. Some people, and it depends on the situation. If we feel comfortable, we'll approach. If the property's occupied, we'll approach them. We try not to draw any attention to the area because we don't want to create competition. But if rarely is the property occupied, I'd say maybe 25% of properties, but we don't have any right to go in them. There's no open house. You're buying them as is, no warranty. That's a risk.
Okay.
I know I drive through alleys. I go through the back. I try to get a full 360. Some of my field underwriters are using a drone to fly over and kind of get a general feel. But absolutely have no right to enter the property. There's become a bit of a strategy with people that are in the lien loan business that are approaching these primarily homeowners or owner occupied properties and trying to cut a deal prior to the auction. We see that getting more and more popular, and then we end up seeing the property back at a tax sale a year later because it's all deferred, extremely high interest rates that are offered to people like in that situation. So the sweet spot, we like to bid on property that's worth somewhere around 80 to 150,000 on the assessed value. In Texas, the assessed value tends to be about 80% of market value. It's kind of a rule of thumb. It may be more than market value in actuality, but the rule of thumb is the assessed value is a pretty good guide. I think it's much more realistic than Zillow or Redfin. But really boots on the ground is what's going to make us different from a lot of people out there are selling courses. A lot of people are going to these weekend training on tax liens and tax deeds, and it's good information they're putting out, but it's a lot of work. You go do all this research, and a large chunk of the properties are paid at the last minute. They're pooled, and you don't even have a chance to bid on them. So it's nothing easy, but it can be really rewarding, depending on how successful we are in our underwriting.
So, John, if there's a mortgage on it, I'm going to guess if it's a significant mortgage, the bank's going to show up at the auction and outbid you. So that, right?
No, they would have, typically, if there's a mortgage, they would have, the firm that files the lawsuit serves every person they can find in the title chains. They have to provide service. Typically, I've never seen the lender show up at a tax sale and outbid us. Now, there's something called overage or surplus, and we're seeing a lot of this here where people are bidding up the amount of their bid over and above the tax. I'll use a scenario. I bid on the lot 2 months ago. It would opening bid around $8,900. It was on the water, worth about $125,000. It got bid up to $82,000. In that case, there was about $70,000 worth of surplus. Now, if there's a lender, they're entitled to make a claim on the surplus. But more importantly, to the average person is whoever was the former owner can make a claim on that surplus also. And that's becoming a very big business space that we're paying attention to internally, is called the surplus excess proceeds, which stays in the county treasurer. Looks like we have someone from the comptroller's office. Is that right, Ted? Are you a comptroller of any state? Okay, so this money stays in the county treasurer's excess proceeds file, And then after 2 years, if nobody makes a claim on that excess funds, it goes to the jurisdictions, the schools, the cities, the counties, and quite frankly, they have no incentive to find these owners. They do a very poor job. They're required to send the notice to the address of record, but typically somebody lost their home, they're not at that address anymore. And so I don't know if I got off the subject there on that last question. Oh,
No, it's okay. It's okay, because
very rarely do you see mortgages on these properties, because the mortgages, remember, require escrow. Typically, they're inherited properties, they're deceased property owners. I mean, it's all those type, typically not very desirable, dilapidated properties. So rarely there's lien mortgage holders, but if there was, they're extinguished, wiped out.
Interesting.
I have another, it's right along with Jonna about, I am not clear about your returns to the investor. And if I am not clear, the investors are not clear, because I understand a lot about how things work, but I don't understand your 12% preferred maybe and your 60-40 split and how that works. And I don't know if you have an example. I didn't see one in there, but I think an example of how that works. So I put in my $10,000. I'm going to get $1,200 a year. Am I going to get that quarterly? Am I going to get that monthly? How am I going to get that? And is that part of the 60-40 split? And how do you know when you're supposed to be getting, because if you're buying 10 homes, don't I get a part of every single home?
Yes, you have ownership interest in every parcel we purchase. The distribution of the profits are going first. There's a 6% total management fee that comes out, 2% when we acquire the property. So if we buy something for
that's your money.
Pardon me?
That's money that goes to you.
To the management entity of which I'm the single sole manager. Yes. And then once we start selling the properties after the redemption period, 6 months, then we'll start earning profits. And those will be, the 12% pref is paid out quarterly before the 60-40 split. Is that clear?
No.
Okay. So
where's that money coming from?
It's coming from
where's
the
12% coming from?
It's coming from the profits in our operations. By the way, all our accounting is done through this portal. We are using a firm called Silicon Prairie Capital Partners. They're a broker dealer. All the monies come into this crowdfunding platform, and they are responsible for generating all the K1s. They help with all the member interactions and accounting. Once the 12% is distributed quarterly, any additional profits before the management entity receives any money on the 60-40 split, the 12% pref goes out. Then the 60%, 40% split goes between the limited member, Class A investor, and the management team. Once the Class A individual member who invested $10,000 is made whole, once they're broke even, they have their entire $10,000 back, either from the interest and the profit distributions. Then we go to the 50-50 split on all the other profits, I should say.
Why aren't you just giving me my 60% of my share? Why is it, what is the 12%?
The 12% is just an incentive to come out first before we get any of our 60%, our 40%, the manager. You following that?
What I'm not following is, where's the money?
The money's
you spent the money. You spent the money by buying these properties. Now you don't, do you have money? You don't have any money. There's no income coming in on it. It's just sitting there. And you spent the money buying whatever it was. And now you're sitting and waiting for the 6 month to go by so you could start marketing those properties.
Yeah.
Where does the income come for the 12% pref?
The 12% pref will come from the profits.
But that won't be until after 6 months down the line, after you sold some of the properties.
Correct. That's correct.
Otherwise, if you're raising funds and you're paying part of that fund back to other investors, we
No,
call that
not
Madoff.
No, that's not what's going on. There may not be a 12%. If there are no profits, there's no 12%.
Right. I think you should do it. I think you should do a little spreadsheet showing that. I think that
Actually, I
for the
have one.
investors.
I do have a complete pro forma. I'm happy to
Okay,
get it upon request.
okay, yeah, so investors need to understand or they're not gonna invest. A confused mind says no.
Absolutely, yeah. I do have a full-blown pro forma that shows how those distributions are and the pref is paid out.
Okay. You probably sent it to me. I just haven't had a chance to look at it. That's it for me for my questions.
While John's looking for the spreadsheet, are you looking for the spreadsheet, John?
No, I can, or we can open up for other questions.
Well, we're not,
Because I think-
this is not available for people right now. They have to contact us and it should be more on a one-on-one or
Okay,
be in the executive plan.
And all these, it's required that anybody who's considering investing goes over this subscription agreement, the Form C disclosure, and Peggy commented how lengthy it is. It's extremely lengthy, and we
John, just get muted.
did I?
Oh, no.
yeah, I think so.
I want to also add that we have, I see your question there, your hand up, Eugene. I'll get right to you, or I guess Jonah will. But I did want to mention that myself and my partners on the management team have all put in a minimum of 25,000. We've raised 150,000 plus, and 80% of that money is going directly into the Reg C CF offering. So we are anticipating we're pretty good shape, capitalized here starting May 7th sale. We should be successful with acquiring.
Great.
Okay, Eugene, do you have a question?
Yeah, can you hear me?
Yeah.
Yes.
Okay. I was driving, so I may have missed some, and I was coming in and out. So when you buy, now you're buying tax liens?
No, sir. It is a lien, but we're buying redeemable deeds.
Okay, you're buying redeemable deeds, and then because there was a part where you were talking about buying down interest rates, which I'm kind of familiar with. Is that how it works in Texas as well, or?
Not at all. No, there's no such thing as buying down interest. There's no liens being sold. It's not an interest play. It's an ownership deal.
Okay, so it's an ownership deal. Now, because I was listening to Peggy's question and I was thinking if it was interest, that's where you're paying the 12% pref, but really is you're purchasing, you get the deed, and then if you're able to sell at the end of 6 months, there'll be a 12% pref first, and then you do the 60-40 split. Is that how it works?
Yes, sir. You got it.
Okay, thank you.
You're welcome. Thanks for that question.
Good. He understands. Yay. That's what I really cared about.
Well, me too. You know, it is so different how each state operates and handles this. It's a necessity. You know, none of us love paying any taxes, but we're certainly most of us recognize the need for I don't know so much the schools these days are kind of disappointing in many ways, but in Texas, it's the biggest chunk of our property taxes goes to schools. Now at age 65, your school taxes get frozen and they never increase anymore. So there's a little bit of relief, and the theory is you're no longer have children in the school system. So I also had a ad valorem property tax consultant license and represented over 400 property owners at the tax appraisal hearing district. So I know the space fairly well in Texas.
Yeah, and y'all do it differently there. Like I'm in California, the prices of the property are registered with the county, and the tax set up under Proposition 13 is 1% of the sale price. So if they pay $100,000, then their taxes are $1,000, and they go up 2% every year. Every year.
Was there a recent law change? Is that about to change?
We're trying to get the death tax taken away because they, Congress, they're not Congress, but our Congress, they double dipped. They put two different things in on one proposition. So they got, the way that's set up is you can inherit your parents' family homes and keep the same tax that it was with the parents. So you're not going to pay a new tax based on they don't go out and appraise the property and say, now you owe 1% based on whatever it is over the 50 or 60 years your parents own that home, which was a great thing. So what they did, I'm sorry?
Does one have to occupy it to keep that basis?
That's the law that they passed last year. They took that part of Proposition 13 and eliminated it and said, if you don't live in the property, and they did crappy marketing saying, oh, all these rich kids keep the properties and rent it out to party people. No, the kids don't have the money, which is why they keep the property, so that they could have an income by renting out the property. Politicians, they want more tax money. So they did that. So we are now working on getting that reversed. We're calling it the death tax.
Well,
We'll see how that goes.
It's constantly, valuations have just gone sky high with the huge run up in sale.
Right. And how somebody who's been living in their home for 50 years able to pay. So they bought the house for $100,000 and now the house is worth $1 million. They're going to pay 1% of the $1 million or whatever they come up with. They don't have that kind of income coming off of Social Security. Remember, 97% of our country has no clue how to keep the money and invest it properly so that they are financially free.
Yep. It's unfortunate, but that's reality. I'll tell you all about one property we bought in 2008. In Orange County, Texas, which is nothing like Orange County, California. It's like the armpit of Texas, east of Beaumont. There's a town called Bridge City where we acquired in, I want to say June or July of 2008. So, real estate's cyclical. We bought it fully insured. 45 days later, Hurricane Ike had the whole city underwater. So I learned real quick how to manage flood insurance and claims. However, what was problematic was it was 2008 and all the jobs left the neighboring city of Port Arthur, Texas. So here we were with 42 doors, and ended up being a long time hold. But we all were made whole after about 7 years, and the market came back. But it was certainly a lot longer play than we anticipated. So you just never know. I mean, there's lots of upside with real estate, lots of red flags as well.
Yeah, so you always have to be paying attention.
We're operating with no debt, and our business model is buying properties at 30, 40 cents on the dollar. So we feel real confident that we're going to make our profit when we buy the right property on the entry side, on the purchase side. That's been my track record. Any other questions?
I don't think so. Can you stop sharing?
I can.
It makes it a little easier to see. And then is Eugene, did we lose Eugene again? I wanted to make sure he had all his questions answered, but I think he probably lost connection again. Well, I think this is really interesting. I do think that Texas is an interesting state from a tax perspective. And it sounds like you've spent a lot of time finding learning all the nuances of it to be able to navigate through this system. Should be interesting too when Travis County goes online.
Yeah, I think it's just a little over a month away, June, the first Tuesday in June. So we'll, right as soon as we get through a week from today, Tuesday sale, we'll be focused on the June counties. And 254 counties in Texas. It's a huge state. Plenty opportunities to make mistakes and to buy right.
Investors don't want the mistake part.
I know it. And that's very extremely important to all of us to minimize.
Yes, that's how you earn your.
Yeah, my real estate attorney is well versed in the mitigation and complications of retail buildings and factories and that sort of thing, what to look for, how to research those and mitigate or eliminate and be aware of those risks.
Yeah, it would be interesting to see the due diligence process, right? What goes on behind this because they're just data files and you look and then you drive by, but without being able to get an inspector in there and whatnot. You must have other ways to do evaluation.
If it's got an improvement on it, we expect the worst. We expect depending if it's occupied, the lights are on, it may be salvageable, maybe not. People live in weird situations. If it's vacant, dilapidated, we're buying it for the dirt.
So do you tear down after the 6 months? Do you tear the
We could
house
do it day
down?
one. We're the owner.
Oh,
We could sell the property day one.
you don't have to wait for the 6 months?
No, but nobody's going to pay you a reasonable amount because they would be subject to the remainder of that redemption period. So we're not going to get 70 cents on the dollar during that first 6 months, but we could convey our title, our sheriff's deed.
Is there a third party report? There's a question in the chat.
Yeah, I think that would be what I referenced in the company called Silicon Prairie, who is our broker dealer. And they have the platform I can't even mention the terms of the offering. It's really the advertising part under regulation crowdfunding, very strict. To see the full terms, you have to go to the crowdfunding portal, and all the investment money has to go to this portal, which I was just showing you, and it's maintained by Silicon Prairie, who is a broker dealer registered and compliant and great track record. We do our diligence on them. Was that what you were referring to, Art?
I think it's Art wanted to know, is there a third party due diligence report on the fund itself, on your CF fund, right, Reg CF?
Hi, if I can interrupt a little bit, because I've worked with Silicon Valley in the past, and under a crowdfunding program, usually a sponsor can talk about the program because you're not soliciting just accredited investors. So you don't need the prior reporting requirements. So I was wondering if there's a third party due diligence report like BIC report or or Buttonwood or any outside third party that's reviewed the fund, reviewed the sponsors, uh,
We
in
have,
relationship to the offering itself.
yeah, it's slipping my mind, but we hired a company. We chose to do a full-blown, uh, it's almost,
Valuation?
financials, what's it called?
Audit?
Audit, yes. We had a full-blown audit done, very expensive, but there wasn't a whole lot. It was just, we formed in October. The audit is from October to December 31st. And other than that, there's no other, you had to pass bad actor test, background check, which I pass all those. I have 30+ years in financial planning, no complaints, no security violations. So, pretty clean guy there. But as far as some offerings like the Reg D 506C, you
Right.
may spend, I heard sometimes as much as $30,000 for a due diligence report and up.
Yeah, it's about 25 to 30,000 for a due diligence report.
Yeah,
for
no,
most funds.
we have not obtained one of those at this point. We do have a little over $50,000 in startup cost, legal, and the thing I just mentioned, the audit.
Okay, can you share that with Peggy and
Yeah, the
everybody?
audit is on the portal.
Okay, it's on the
Audit.
portal.
In fact, it's part of the filing. We couldn't file the Form C with the SEC until the audit was completed.
So everyone has to register as opposed to you being as a sponsor being able to share the information. Everyone's got to register at Silicon Valley in order
It's
to receive
Silicon
the
Prairie.
information.
It's
Right.
yeah, everybody has to register, set up a login. I believe you can access the Form C and the subscription agreement without creating a login. You can just
Okay.
kind of go to that invest.coretaxdeeds.com is the site that is maintained by Silicon Prairie. I appreciate you sharing that with me about what we can say as a sponsor. And there's
Yeah,
two.
I've been a sponsor for over 78 public programs, so I've
Oh.
gone through the process, raised $2.5 billion in the past. So crowdfunding is a wide open platform. So because you're working with non-accredited investors, they're allowed to access your information, you're allowed to disseminate the information. So it's a free form public presentation, as opposed to what we have to do with the Regulation D, where you have to make sure they're accredited, you have to go through the process, you have to go through all free reps. With a Regulation C or C plus or any of the crowdfunding formats, it's a lot freer, a lot easier.
Yeah, there is a kind of a income requirement, but it's like if you want to invest 10,000, you have to have income of like 30,000.
30,000, yeah. It's
Or
not really a requirement, but yeah.
Or your net worth, if you're going to invest whatever, 15,000, you have to have like maybe, I don't know the exact number, $150,000 in assets, but it's pretty minimum. There are some thresholds. So to protect, I mean, it's certainly not like the Wild Wild West. We had to go through a huge amount of vetting, huge amount of legal work. And I've already this is my second fund. I have a Reg D with the same law firm, but they had to bring in, believe it or not, the law firm I use is called Crowdfunding Lawyers 101. Nathaniel
Sure.
Dotson.
Yeah.
So he's pretty, I mean, his name's Crowdfunding Lawyers, but he had to bring in another crowdfunding lawyer in our case because there's some regulations about blind pools and
Yeah,
whether or not
sure,
we were a
sure.
blind pool. It caused us about a 45-day delay, but because we identified we're buying specifically non-homestead properties in Texas, and our criteria is 30 cents on the dollar. We're not a blind pool. We had to convince the regulators that we're not ineligible. A blind pool is ineligible under a Reg CF offer.
Right, yeah.
I think I'm not a lawyer, but I've been
No,
hung up with them
we all
for-
play ones. Yes, exactly.
No, I won't even play one, but I've been hung up with them for the last 5 months and
Yeah.
not been fun.
All right, we're almost at the top of the hour. I'm going to